Welcome back, everyone, to the second episode of the series where I'm going to be tracking weekly buys in this portfolio. I've decided to skip forward a few steps in order of saving on words later. Instead of episode two, I'm going to track by the number of, well, the average monthly dividend. So episode 403 instead of episode 2, we just have to pretend that we skipped like 401 episodes. Anyway, so as always, you know the drill. Not financial advice. Do your own due diligence on all the stocks I mention. And yep, this is a series. The goal basically for now is to add $1 a month worth of dividends and then add some total returns, growth, and that type of thing. Today, this week, I should say, I bought 3 stocks. One preferred share company, which sounds weird to say. The other is an energy company, and the third is a lending company with high return on equity. I'm just going to say a few words about each of the stocks, and bear with me for the next few weeks, especially as I'm trying to figure out what format works best for this type of thing and the best way to do it. I'm probably going to have a few different ways of showing things because I'm still trying to figure out what format is the most efficient. So the first stock that I bought this week is Allaris, and I bought a whopping 6 shares. So, rich man. But I spoke about last week a little bit the return on equity, return on investment, and IRR that I thought I was getting. So this week I figured I would talk a little bit more about the business and like what they do. What Allaris does, the bulk of their deals, what it used to be at least, is they would invest in private companies and preferred equity deals, which means basically they give companies money and they get a 14% yield. It's not quite debt, not quite equity, somewhere in the middle, hence preferred equity. Now, the difference between them and what a number of other companies do on a preferred equity deal is Allaris, they would have a collar on the rate. So basically, they'd set it up so if the company grows revenue, call it by 1 to 5%. I don't know if it's always exactly 1 for 1, but let's say the company is able to use the money effectively and grow. The rate that Allaris would be paid by the company would grow along with it. So basically, you get the 14% plus 1%, 2%, 3%, or so on if the company is able to use the money effectively. So year 1 might be 14%, year 2 might be the equivalent of 16% because the revenue grew by a few percent. So that's how they're able to get the 14% plus hopefully slight growth. Now, on the other hand, in negative environments, if the revenue from the company were to fall by a few percent, then they could also that amount can go down. And obviously, not all investments will work, so there will be some losers. But on balance, they seem to have been effective with this strategy. Now, in recent years, they have traded at a discount to their own book value. And while when they used to trade at a premium, it was easy for them to issue shares at a premium and do even better on the deals because they were getting 14% yield on dollars that were costing them cents. Recently, the reverse has happened. So what they've had to do, or what they've been able to do, is basically farm in some outside investors to give them capital to get the deals, while investing some of their own capital that has been recycled. So ironically, while this also gives them the ability to buy back their shares at a discount to book, it probably also will increase their yield on book because, or the return on equity, because they're getting returns without having to put in more equity. Next, I bought 4 whole shares, of Strathcona Resources. That's an energy stock, oil and gas, trades on the TSX. Now, I told myself that I don't want to go too much into commodities in this type of portfolio. And that's because the idea behind this is buy and hold and not babysitting the positions. Now, maybe I'm already breaking the rule, not sure. But part of the outlook and part of the reason why I think Strathcona might also fit the bill for this portfolio is their focus on, or their outline of returning capital to shareholders, particularly in the form of dividends, which aren't necessarily as influenced by the month-to-month valuation that the stock price is trading. So when I look at Strathcona today from this, this price, what I think I'm getting is a normalized high teens yield, basically. I think there's going to be some growth. Trying to pin down exactly what yield requires you to have a short, medium, and long-term idea of exactly what the price of oil is going to be. And I have an idea of what the price of oil probably might be, but I don't know what it will be. So, I mean, a few years ago, every time I have something not bullish to say on oil, people don't like it. That's fine. I don't care. Everyone's entitled to their opinion. But I was too cautious, I think, a few years ago. I said kind of oil mostly works at $65. Now I think that's wrong. I think the right price is in the 70s, somewhere in the 70s. But I mean, when I say right price, I mean I expect it to go below that. I expect it to go above that at times. But I think that gravity is in the 70s. So in the 70s, I think from here, the yield on Strathcona is high teens, if not higher once the growth kicks in. But there is potential in the short term slower. But yeah, I'm getting a bit rambly here because nobody knows what the price of oil is going to be. I think Strathcona works very well at $70 oil, and especially at this price, at this share price in the high 20s, I think it works well in the low 30s at that price. Even building in a buffer of it's a commodity company, and they could, even though they have been very very good with capital deployment in the past, they could always do something dumb because, again, they're a commodity company. So I think I have enough of a buffer on that, but that's my bet, and that's why I bought 4 shares this week. Lastly, I bought 5 shares of Propel. If your OCD is triggering you at the moment, for me going 5-6-4-5 instead of 6-5-4, you're not the only one, and I don't know why I did it this way. Now, Propel is a business in a sector that I'm surprised there's not more people that love it. It has high customer churn, endless charge-offs, broke. Your customers are by definition very broke. And furthermore, this stock trades at a very high price to book, which is, not great for a financial, and pays too much of their earnings in dividends. Oh yeah, I was supposed to be talking about why I like it as a long, not why I like it as a short. Okay, so the upside for Propel is they trade at what seems like a very reasonable valuation, given that they earn very high returns on equity. I mean, they've been earning high 20s, 30s, up to 40s return on equity. And I know what some of you might say, isn't that dangerous for an alternative lender or a consumer lender? And the answer is maybe. It could very well be dangerous. I know that there are, like a peer, for instance, Go Easy has been earning 20s return on equity for a long time. Propel is kind of in a similar niche, similar markets. It is not a business that I would have as a high double-digit percentage of the portfolio, but in a portfolio like this, where I want more diversification, B, want more smaller positions, it's something I've been watching for a while. And they've guided for 30s return on equity this year, and that's the type of thing that allows a company to grow a significant amount, even if they're paying, as I honestly meant, too much in dividends. And when I say too much in dividends, I mean when you earn 30% return on equity, you don't want to be paying any dividends, ideally. So yeah, it's an alternative lender. I'm just kind of picking away at starting a position. Their growth, I mean, I don't look at necessarily growth in the same way for this type of thing, because you can always grow very, very quickly when you're in alternative lending by simply taking too much risk. And so I don't think they have, but I mean, this small position is kind of something I want, maybe a few more than 5 shares, believe it or not, I would like to get to. But it's just something I feel like might nip away at here and there and just tuck into the portfolio. 3% yield. They grew that dividend by about I'm tempted to say more than 5% for each of the last 4 quarters, growing it quickly, perhaps too quickly. But yeah, that's the third stock that I bought this week. And those were the 3 stocks that I bought this week. Every week's probably going to be a little bit different, different number of stocks and different things being said about them. Also, stay tuned in the future. I'm going to probably have some other non-stocks I'm buying videos about this account and about some other things, and about stock outlook in general. But that is all I have to say for today. Thank you for watching, and until next time, have a great day.